everybody. Welcome to another episode of Coffee with Kelly. And today I actually have coffee cups, as been pointed out to me. For some of you that don't know, I am a loan originator with the company Loan Depot. And with all of the information and questions that I've been getting lately out on the mortgage industry, I thought a great guest would be my manager, Matt McCain. Matt, can you tell us a little bit about your background first?
Thanks. Great to be here, by the way. Love the set. I've been in the business for 25 years. I've been managing loan officers for the past 18 years. And a lot of times it's the unsolvable problems. I've got a lot of great loan officers, so we've got great support people. Problems don't usually land on my desk until a lot of really smart people have had a shot at them. So,
and it's really on fire.
And something needs attention.
Yeah,
but we work for a great company, and
we do.
I've been with Loan Depot for 9 years now, and they just give me every opportunity to help people achieve and maintain the dream of home ownership. So it's been a great place to be.
That's awesome. Well, today I wanted to have you talk about those loan level pricing adjustments. I keep getting asked about it. Are they really, am I going to be punished because I have great credit, and these people who don't have credit, maybe I should stop paying my bills, because I'm going to get a better interest rate. So maybe you can touch a little bit on that so that everybody can understand, because I know it's pretty complicated.
Yeah, so it's first off, everyone has a May 1st date in their head. But what you need to understand is May 1st is when we deliver the loans to Fannie Mae. Mm-hmm. So this didn't just happen May 1st. This happened several months ago. It had to be priced in. If it was a loan that we were going to deliver by May 1st, it means that we had to close it by the first couple of weeks in April, which means that we had built this into the pricing back at the beginning of March, so that as we were pricing and locking in loans, it was happening at that time. So for a lot of us in the mortgage business, when this started getting press around, the beginning of May, we'd already been pricing this in. Here's a couple of things that you need to understand. Number one, it doesn't impact you if you already have a mortgage. They're not changing your current mortgage rate. So
correct.
It's only brand new mortgages. And here's what has happened. There is never a place where somebody with really good credit is going to pay more than somebody who has really bad credit. That's still going to be better. Here's what happened. The price that someone with bad credit had been paying, or average credit had been paying, was substantially more expensive.
Okay.
So Fannie Mae made changes to what are called loan level pricing adjustments. And just so you know, they're always there. They've been there.
Yes.
You don't ever see them as a consumer. You don't see them as the realtor, because we just tell you what the rate is. But if your credit score is a 660 and you're putting 5% down, your rate might have been way up here. If your credit score was 780 and you were putting 20% down, right, your rate might have been a lot lower.
Right.
All that's changed is that they have closed this gap. They have made it less punitive to have average credit, and it's not quite as beneficial if you have really good credit. That's it. The rate you get with really good credit is still substantially better than the higher rate you're going to pay if you have marginal credit. That's it.
That's it.
They've just closed that gap. But the thing that I think people don't understand is, with these loan level pricing adjustments, every lender applies them differently.
That's
what
true.
loan level pricing adjustments are doing, it's what we pay when we deliver a loan
Correct.
to Fannie Mae. It's not a dollar for dollar, this is what you have to pay. Some lenders will pass it on directly to the customer, exactly as Fannie Mae does it. And others will manipulate what they're actually charging their customers. Think of it this way. If your gas station has to pay a half a penny more per gallon of gas when they purchase the gas, they can't charge you a half a penny more. So they have to decide, do we leave the price where it is, or do we raise it a penny per gallon? All of them are going to handle it a little bit differently. And that's the way these loan level pricing adjustments are working. It's already baked into whatever rate is being delivered to you.
So that would be why when a consumer's out there shopping rates, that they may get a slightly different rate or pricing or loan level adjustment pricing on that loan. And it just depends on how that lender is passing it along.
That's exactly what
Okay.
it is.
Okay.
Yep.
So then my next question for you, my next topic is, a lot of consumers, and this is what I'm hearing from realtors, are saying, well, I'm going to wait. Now's not the time to buy. The interest rates are too high. As you and I know, that's not always the best thing to do. There's other factors to look at, prices of housing, the availability of housing, and things like that.
So this is always one of the interesting questions, right? And unfortunately, you never know what the right answer is.
You don't.
Until you're able to look back in time and say, all right, where exactly was the bottom of the market? Where was the top of the market? It was funny. I remember, 5-10 years after the crash, trying to get people to identify where the top of the market was in 2005 or 2006. And then trying to get them to identify where the bottom of the market was, because in each bucket it can be a little bit different. Here's the piece that I consistently look at. I'm trying to watch what's happening with new purchase activity and how does that relate to how many homes are available for sale on the market. It doesn't matter what you're selling. All of these things come down to supply and demand. If there's an oversupply, prices drop. That's what happened in 2008, right? All of the homes that all of these builders had been building that nobody wanted to close on, and we ended up with 4 million homes for sale, and because there was so much oversupply, it drove the prices down. Right now, we don't have an oversupply. We still have a ton of pent-up demand. We have people who have wanted to buy, and they were trying to buy in 2021, and because we had a supply issue then, they couldn't get into a property in 2021.
Exactly.
So they rented for a year. Their leases came up at the end of 2022. Well, we just got hit with a hurricane at that point, which means that we've lost more houses that are no longer inhabitable.
Correct.
So we are still in a supply issue. We don't have enough homes. So a lot of the people who are saying, well, I want to wait, what they're waiting for is they're waiting for the rates to come back down, or they're waiting for the home prices to come back down. So if there's a large portion of people that are currently sitting and waiting for interest rates to come down, eventually that happens, right? When is it going to happen? It's anybody's best guess. But if you're waiting for the rates to come down, and there's a huge group of people waiting for the rates to come down, once that happens, now we have a situation where we're dumping a lot of new buyers into the market, but we haven't increased the supply.
No.
And if the rates went from 6.5% and we drop back down to, let's say it only drops back down to 5%.
5%.
It's going to spur a lot of people back into the market again. But because they were qualified at 6.5 and now their rate is 5, they're willing to pay a little bit more for that house because they have more buying power because their interest rate is lower.
Well, and that's just it. That difference in that rate is what makes that house payment affordable.
Huge.
It's
huge. So now people are willing to spend a little bit more because they feel like they're getting more value. You're not. You're paying more for the house. You're just getting it now at the lower interest rate. And the problem with that is that we don't have shadow inventory. We don't have a bunch of houses ready to hit the market. And because there's not enough inventory, when we add more buyers into that buying pool, it's going to continue to drive the prices up. Again, it's just supply and demand. So if someone's thinking about buying today, but they're going, well, I should really wait until the rates come down, it's going to be substantially more expensive to do that because the house is going to appreciate as those rates come back down because we simply don't have enough inventory.
Correct.
So you buy it now. There's a saying that we've been hearing for the last couple of years, right?
Yes,
Marry the house, date the mortgage.
Yes.
Right? You're probably going to end up with an interest rate that's higher than you wanted to pay, but you're buying the house here. And if the rates drop and your equity increases in the house, the value of the home increases, that's money that you've made, right? That's appreciation that you're gaining. And when the rates drop, and you refinance, now you're getting the lower rate that you wanted that wasn't available previously, but you've earned the appreciation in the home.
Right, because you've got more of a better loan to value. You've got a lesser loan to value, and that usually gives you a better interest rate.
It makes it easier to refinance at a lower rate. And again, you get to find that house now, because ultimately we all need a place to live, right?
Right.
We saw a lot of people who said, well, with the values going up and the insurance going up, I'm just gonna wait and I'm gonna rent for right now. The problem with that is the person who owns the house, or the corporation that owns that apartment complex, or whoever it is paying a higher insurance rate. If they bought the house last year, they're paying a higher interest rate when they bought it, which means your rent is going up as well.
Exactly.
And if you're paying more money in rent, it's still money that you're wasting. You're not getting any return on that.
Exactly. You could be paying a mortgage all that time and getting the equity in the house, and you've got to look at a home as another asset, because it is going to appreciate. Now, we had a freak thing happen back in 2009, but that's because we had too much of an inventory at that time.
What happened?
And we didn't have the demand.
Yeah. So what happened back in that? I call it the time of great sadness.
Yes, you
right?
do.
What we had happen at that point was that the lending guidelines had gotten so loose that it was very easy for people to obtain financing, and you had people purchasing homes that they never intended to occupy.
Correct.
They didn't even intend to rent them out. They just intended to buy it, wait, flip it, and make their money on it. And the problem that we stepped into was that the builders overbuilt. We simply built too many homes. And that was the big problem, was that we had too much inventory. The builders this time, number one, they haven't been building enough homes for the past decade, because by the time they all came out of, the time of great sadness in 12 and 13, obviously they had a lot more caution.
A lot of them weren't solvent.
They were smarter this time about not getting out over their skis.
Yes.
Right? None of us wanted to believe that how bad it could get, as they were building and developing in 05 and 06. But the other challenge they ran into over the past couple of years is, because of COVID, you had supply chain issues that was causing major problems.
Yes.
You had problems finding labor. And one of the big ones was the fluctuating cost of supplies.
Correct.
So there were items that, aluminum got very expensive, so that was driving up the cost of windows. And then you couldn't get, specific parts
like
to the house.
2x4s and stuff.
Plywood got crazy. So when all of these prices were fluctuating, the problem with that is, if you want to have me build you a new house and we negotiate a price today, but I've got 3 months or 4 months before I can get through permitting and start locking in some of my costs, the cost of my end product is an unknown variable, because I have so many different pieces that are fluctuating, and I don't even know if I can find enough labor to actually get the house built.
And that's why a lot of them have gone to, we're going to start the house and then we're going to put it on the market more of like what they call a spec home, a speculated home, where they don't have an owner. And you're starting to see more and more of that available. And that's so the builders can control their cost.
And what it's done is, it has put us in a position where we have not built enough homes to meet the demands of all of the new households that are being created. So it's contributed to prices just continuing to escalate.
Right.
Because it's again, supply and demand. There are more people who want to buy houses in our market than houses that are available.
A lot of people want to move to Florida.
I usually look at certain buckets of housing prices.
Okay.
And one of the ones that I look at is, Naples, 600,000 single family on 1 acre. And for most of last year, up until the hurricane, the number of available houses kept getting bigger and bigger and bigger, right? And that particular bucket, there'd be 150 houses, and then you throw out the new construction, and you throw out the pending contingents, because you can't buy a house that's already under contract.
Correct.
And you'd end up with, 80 to 90 houses. today there was, almost 150 homes that were in that same bucket,
Right.
but 100 plus were pending contingent.
Oh, wow.
So the same number of houses that were out there, they're still listed on the market, but 65, 70% of them aren't available for purchase because somebody else is already under contract. And then I looked at, the market in Lehigh Acres and looked at 300,000 and under, and it was very similar. 65% of what was out there was pending contingent. And the actual number of homes that you could make an offer on today and move your family into in 30 to 45 days, very, very small. And it's that way across most of Southwest Florida right now.
It is. And of course, like Matt said, we had a hurricane come through, and you talk about trying to get more supply into the area to fix these homes, to sell them. And then you have people that want to sell their homes and they don't want to fix them up. We were talking today about our renovation loans that we do at Loan Depot, and this is something that these people, that the buyers can do. And we talked about insurance on these homes, that there is a way for us to do that with a builder's risk.
Builder's risk policy. Essentially what it does is during the period of time when the house is uninhabitable because we're doing the renovations to it, that covers that it makes sure that the property's insured.
Yeah. So that's also another option for people wanting to buy homes in the area and having some difficulty with the inventory. I know that we got a little bit away from interest rates, but there's something that I'm seeing more and more. People are asking about these buy down loans.
Yep.
And adjustable rates. I look at the adjustable rates, and to me they seem kind of costly, but I don't want to get into that. I want to talk about, is it smart to do a buy down, knowing that you're probably, if you're buying a house now, you're refinancing in the next few years. Would you not agree?
I would say that most everyone that we've done a loan for in the past 12 months is going to end up refinancing within the next 12 to 24 months.
Yes, I agree. So is it really a smart thing to do a buy down right now, in your opinion? Or what do you think?
So there's a couple different types of buy down.
Okay.
And you also mentioned ARMs. So
Yes.
right now, on conventional, there's not a lot of good adjustable rate mortgage products. And typically the way that works is, the loan and the interest rate is fixed for 5 years or 7 years or 10 years, and then it becomes an adjustable rate after that. Right now we have an inverted yield curve, and because of that, there's no real value. The interest rates that you're getting on ARMs aren't better than what you're getting on fixed.
And that's what I'm
There's
seeing.
certain buckets where it might be, but not enough to justify, doing the risk.
Right.
Where you see the benefit is really more on the jumbo side.
Okay.
You'll see a lot of the jumbo ARMs are much better. That's a place where it makes more sense. But
yes.
right now on conventional, it's not as
Not
cost
something
effective.
Okay.
So there's two different types of buy downs.
Yes.
So there is a temporary buy down and there's a permanent buy down. So most people are familiar with a permanent buy down. So for example, let's say today's interest rate, based on all of your LLPAs, was 6.5%, and we were able to give that to you without charging any points.
Okay.
Right? It would be what we would call a 0-point rate or a par rate. So let's say that based on your scenario, you were at 6.5%. And let's say that you wanted to have a rate of 6.25.
Okay.
You could buy down the rate by paying discount points up front.
Correct.
So maybe it's 1% of the loan amount. So if it were 1 point to buy down to 6.25 and your loan was $300,000, it would be a $3,000 fee to do that. And typically it takes a few years to make up the cost of buying it down. So you start looking at how much am I saving every month, and say it's $25 or $50, whatever it is. And then you figure out, okay, I save $50 a month. How long does it take me to get to $3,000? That's 60 months. Does it make sense? And in that case, it's usually going to be a no. Right now, it's absolutely a no, because we know that somebody who does that today is going to refinance in the next 12 to 24 months.
Yes.
If you're at 6.5 or 6.25,
Yes.
and the rate drops to 5%,
You're refinancing.
we're refinancing you. And what it means is that $3,000 that you spent to buy down the interest rate is gone.
You've wasted it.
You didn't get the benefits out of it.
You didn't get the full
So
benefit.
that's a permanent buy down. And when we look at a permanent buy down, we look at using that when someone is in a position where there's not a lot of likelihood that they're going to refinance during that time period. Well, we know that's not the case. So the other one is called a temporary buy down. So let's go back to our 6.5 interest rate.
Right.
And there are a number of different buy downs. You'll see a 3-2-1, you'll see
Yes.
a 2-1, you'll see a 1-0 buy down. Basically what it means is how many points can you reduce that interest rate? So let's say that you do a 2-1 buy down.
Yep.
Means that the rate that we're giving you is 6.5, but for the first year, your payment is going to be based on 4.5.
Correct.
The second year, it would be based on 5.5. And the third year, it would return to the 6.5%.
And stay there for the remainder of the loan.
Right. So that's a 2-1 temporary buy down.
Okay.
So I like temporary buy downs. And the reason that I like them is because whatever the cost is to do that buy down, and usually a 2-1 buy down is going to cost about 2 points. So if you had a $300,000 loan, it would cost about $6,000. Now, usually we want to get the money from the seller in the form of a concession. Maybe the builder is offering an incentive, right?
And some of them are right now.
So if we're able to negotiate a concession from the seller, our buyer isn't paying for the buy down.
Correct.
Right? It's coming out of someone else's funds. So let's say that we do a 2-1 buy down. Our customer got a rate of 6.5.
Okay.
First year they're going to be at 4.5.
Right.
Second year they're going to be at 5.5, and then
Right.
they return to the other one, and it costs $6,000. So let's say that we do that. We use a seller concession, but at the end of the year, rates have dropped to 5%,
Yep.
and our customer says, "I want to refinance." Well, they spent $6,000 to do this buy down. If there's still $5,000 of that money left over, when we refinance, that $5,000 is reduced from the principal balance of the mortgage, so that money isn't wasted. They still get the benefit of that money because it reduces the principal balance when we refinance them. So it goes a long way.
So that's to their advantage.
It's a huge advantage. So what a buy down is going to do for a customer in that situation, it's going to give them a lower payment today and make the house more affordable as they move in and they're spending money to do whatever it is that they want to do in that new home.
Thanks, Matt. Well, that's our time for today. I hope we didn't confuse you too much on interest rates. I want to thank Matt for coming and visiting with me and giving us all this great information. Until next time, thanks for tuning in.